France's real estate market in 2026 represents a country moving through a profound structural transition shaped by shifting demographics, evolving financial conditions, tightening environmental regulations, and a recalibration of investor expectations after several years of volatility, with the residential and commercial sectors each responding differently to the interplay of interest rates, supply constraints, and regional disparities. The market, which experienced a sharp contraction in transaction volume during the 2023 to 2024 credit tightening cycle, began to recover in 2025 as banks cautiously reopened lending channels and households adjusted to the new interest rate environment. And by 2026, the number of annual sales continues to rise, though buyers remain more analytical, more price-sensitive, and more focused on long-term value than during the speculative surges of the late 2000s, creating a climate where negotiation has returned, seller expectations have moderated, and the market is driven less by emotional urgency and more by rational assessment of property condition, location, and energy performance. Paris remains the gravitational center of national and international demand. Yet the capital's market is increasingly segmented, with the historic core, particularly the 6th, 7th, and 8th arrondissements, maintaining extraordinary price resilience due to chronic supply shortages, heritage protections, and global prestige, while outer arrondissements and the Île-de-France commuter belt experience softer pricing, longer selling times, and a growing emphasis on energy-efficient renovations as France's environmental regulations tighten under the Loi Climat et Résilience, pushing buyers to prioritize properties with strong energy ratings and penalizing older, poorly insulated buildings that require costly upgrades. Regional markets reveal even more pronounced contrasts, with cities like Lyon, Bordeaux, Nantes, Toulouse, and Montpellier benefiting from strong employment bases, university populations, and continued population inflows, while smaller towns and rural areas, despite the temporary surge in demand during the remote work boom, now face a recalibration as some buyers return to urban convenience, renovation costs rise, and the appeal of long-distance commuting diminishes, though certain rural regions with strong tourism, such as Provence, the Dordogne, and parts of Brittany, continue to attract second-home buyers and retirees seeking lifestyle properties. The luxury segment operates on its own trajectory, driven by international capital, lifestyle migration, and France's enduring appeal as a safe, culturally rich, and politically stable destination for long-term asset preservation, with high-net-worth buyers focusing on Paris, the Riviera, Provence, and select alpine markets where scarcity ensures price durability and where trophy properties continue to command extraordinary premiums. On the commercial side, 2026 marks a pivotal year of structural adjustment, with the office sector undergoing a profound rebalancing as hybrid work patterns become permanent, pushing companies to reduce footprints, upgrade to higher-quality energy-efficient buildings, and abandon outdated stock, creating a widening performance gap between prime central business district assets, which remain highly sought after, and secondary suburban offices, which face rising vacancy, declining rents, and the need for repositioning or conversion into residential or mixed-use developments. Logistics real estate continues to outperform, fueled by e-commerce, supply chain diversification, and France's strategic location within Europe, though developers face stricter environmental and land use constraints that limit new supply and push investors toward redevelopment of existing industrial zones. Retail property, long challenged by shifting consumer habits, shows signs of selective revival in high-traffic urban corridors and tourist destinations, while secondary retail continues to struggle unless anchored by essential services or integrated into mixed-use revitalization projects. Hospitality assets benefit from France's robust tourism recovery, with Paris, Nice, Marseille, and the Alps experiencing strong occupancy and rising investor interest ahead of major international events and sustained global travel demand. Institutional investors, who faced a significant financing gap in 2024 to 2025 as debt matured under higher interest rates, are now cautiously re-entering the market, focusing on core assets, stable income streams, and sectors aligned with long-term demographic and technological trends, while private buyers and family offices increasingly dominate smaller transactions. Overall, the French real estate market in 2026 is defined by stabilization rather than exuberance, by strategic repositioning rather than rapid expansion, and by a gradual return to equilibrium as buyers, sellers, lenders, and policymakers adapt to a new environment shaped by sustainability requirements, demographic shifts, and a more disciplined approach to valuation, all contributing to a landscape where opportunities remain abundant but require sharper analysis, longer time horizons, and a clear understanding of regional dynamics to navigate effectively.